Economic downturns can catch everyone off guard. Economists had been predicting an economic downturn for months, with the majority expecting it to begin in the start of 2023. It's debatable whether the recession is severe or shallow, long or short, but analysts agree that the economy is entering a period of decline. What is the reason behind that, and why the majority of the economists believe that the financial crisis of 2023 is much severe than that of 2008? In today's video, we are going to uncover all of the facts and the causes of the Fed crashing the whole economy and the financial crisis 2023. So, let's get started. Based on new World Bank studies, the entire world's economy is in danger of losing a decade of growth, which would be considerably worse if the present economic instability triggered a worldwide financial crisis. On Monday, an international organization warned that the COVID-19 outbreak and the Russian takeover of Ukraine will have long-term consequences for the world's economy, weakening efforts to raise worldwide living requirements, increase poverty, and tackle the effects of climate change. Its analysis found that recent global economic setbacks have had a long-term lasting impact, reducing growth rates this decade by a third as opposed to the first 10 years of the 21st century. On March 22, 2023, the Federal Reserve made a decision whether to continue its strong fight over inflation or to put it on hold. The chief economist at Moody's Analytics, Mark Zandi, stated that traditionally, when there is significant inflation and the Fed raises interest rates to combat inflation, there is an economic downturn or recession. That is typically the case that a traditional overheating situation in the economy leads to a recession. This story has been told before. When inflation rises and the Fed reacts by raising interest rates, the economy eventually collapses under the strain of rising interest rates. Mark is among the analysts who feel the Federal Reserve may prevent an economic downturn by raising interest rates just enough to keep growth from halting. However, he stated that the economy is expected to collapse. He continued saying that downturns usually creep up on us. Executives never discuss economic crisis. He said that CEOs appear to be tripping over themselves to declare that we are entering a recession. Everyone on television is predicting a recession. Every economist predicts a financial crisis. Fed being the reason behind the economic collapse. Interestingly, the Fed is negatively impacting the economy after stabilizing it in the previous two downturns. The central bank aided lending by lowering interest rates to zero and increasing market liquidity through adding trillions of dollars to its balance sheet. It is now shrinking that balance sheet, and interest rates have risen quickly from zero in March to a range of 4.25% to 4.5% this month. However, during the previous two downturns, authorities weren't concerned about high inflation draining into consumer or corporate spending power and crawling throughout the economy via supply chain and growing wages. The Fed is now fighting a significant struggle against inflation. It expects more rate excursions up to around 5.1% by early next year. And the economists believe it will keep those high rates in place to reduce inflation. Higher interest rates are already having an impact on the housing market, with home sales down 35.4% year-on-year in November, the 10th month in a row. The 30-year-old loan rate is approaching 7%. In November, consumer inflation was still rising at a blistering 7.1% annual rate. Money market specialist at Jefferies, Tom Simpson, said that one must clean the dust from their economics textbook, as the financial crisis of 2023 is anticipated to be a typical crisis. He further stated that the transmission mechanism is visible first around the beginning of this year, when they began to witness some considerable reductions in business profits. When that becomes apparent, people will begin to reduce their expenditures. The first place that will see it is in headcount reduction. That will be evident by the middle of this year. when economic growth will slow sharply and inflation will fall. How much worse is the crisis going to be? Recession is defined as a long-term economic slowdown that impacts the entire economy and often lasts 2 quarters or more. The National Bureau of Economic Research, the judge of recessions, evaluates the severity of the slowdown, its breadth and duration. However, if any of these factors become bad enough, the NBER may declare an economic downturn. For example, the pandemic downturn in 2020 was so unexpected and severe, with such far-reaching consequences that it was considered to be a recession, despite its brief duration. The Federal Reserve's most recent economic estimates foresee the country's GDP growing at a 0.5% annual rate in 2023. With no indication of an economic downturn, Swank said that we all are facing this financial downturn because Fed is trying to create one. She further explained that when it is suggested that growth will slow to zero, then the unemployment rate will climb. The Fed clearly forecasts a recession, but they refuse to say so. Central Bank predicts that unemployment will rise to 4.6% next year, up from 3.7% now. What is the SVB problem and how much worse it has gotten? The Fed might worsen the problem that caused Silicon Valley's banks problems for other banks. This is because the Fed is at least partly to blame for what occurred. Banks primarily fund themselves by accepting deposits. They then use those relatively short-term savings to lend or make longer-term investment at a greater interest rates. However, putting short-term deposits in longer-term securities, including ultra-safe U.S. Treasuries, raises the rate of interest risk. When interest rates rise, as they did in 2022, the value of current bonds falls. SVB was compelled to sell $21 billion in assets that had lost value due to the Fed's rate hikes at a $1.8 billion loss, precipitating its catastrophe. It ended when SVB depositors learned of it and attempted to withdraw $42 billion on March 9 alone. Called an ideal bank rush, the bank was simply unable to meet the expectations. However, the bank industry as a whole is sitting on hundreds of billions of dollars in remaining losses. That is $620 billion as of December 31, 2022. And if interest rates continue to rise, the value of these bonds would fall, further weakening banks' financial position. Now, let's talk about the economic slowdown. While this may appear to be an obvious choice for delaying rate hikes, it is not. The rise in inflation has been a serious concern for the U.S. market since 2021, as consumer prices for homes, vehicles, food, energy, and other goods have risen. When consumer prices rose this much in early 1980s, the Fed had to hike rates to such an extent that the U.S. economy went into economic downturn twice. Inflation swiftly decreases the amount of items you can buy with your money. It also makes it more difficult to save money because it drains the worth of your savings. When high inflation persists for an extended period of time, it becomes embedded in expectations, making it difficult to control. This explains why the Federal Reserve raised rates or prices so quickly. Furthermore, it is unclear that it has done sufficient to bring prices down to its 2% target. So a pause in raising rates would imply that inflation would remain higher for longer. Furthermore, abandoning its 1-year-of-age inflation effort may send the wrong signal to buyers. If central bankers demonstrate genuine concern about a potential banking catastrophe, the market may conclude that the Fed is aware that the banking industry is in significant trouble and that the situation is worse than previously envisioned. So, what should the Fed do? At a minimum, some cracks are appearing in the complicated global financial system. 3 banks in the United States failed in a couple of days. Credit Suisse, a 166-year-old Swiss bank, was on the verge of failure until the government negotiated an affordable sale to compete with USB. A $30 billion rescue for local U.S. bank First Republic failed to halt the company's share price decline. Banks in the United States are asking Fed loans as if it were 2008, when the economy nearly imploded, and liquidity in the Treasury market, which is essentially the lifeblood of financial markets, is decreasing. Prior to Silicon Valley's bank failure, interest rate contracts predicted that rates would rise by 0.25 to 0.5 percentage points on March 22. The likelihood of no rise rose to 45% on March 15 before decreasing to 30% early on March 20, with the remainder of chance on a 0.25 percentage point increase. Increasing interest rates at this time would put more strain on an already stressed structure, and if things deteriorate, the Federal Reserve will very certainly have to make a swift U-turn, which will gravely damage the Fed's reputation and capacity of performing its job. Members of the Federal Reserve are right to be concerned about battling inflation, but they also don't want to set off a financial catastrophe, which might push the United States into crisis. As economists have been concerned about the Fed's inflation struggle, recessions caused by financial crises are typically deep and prolonged, affecting millions of people. What do you think about that? Let us know about your thoughts in the comments section below. If you're new to this channel, hit the like button and subscribe to the channel. Also, press the bell icon so you never miss an update. Thanks for watching and see you next time.